Welcome back, everyone. In this episode, we're going to take a look at two undervalued growth stocks that have seen a major pullback of over 40% in 2022 and are now considered undervalued at their current share price and may make a nice addition to a growth portfolio to start out 2023. For both these companies, we're going to go over their current operations, evaluate their current financial statements, and take a look at their future growth opportunities. So before we jump into that first stock, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and on this channel we talk about the stock market, go over any major market news, and we track the progress on my personal portfolio that now sits at a value of $167,000. So right away, we're going to jump straight in to the first growth company we're going to focus on in today's video, and that is ticker ADB for Adobe. They currently trade for $336 per share and are now down over 40% on the 12-month chart. They're sitting near the bottom on the 52-week range and are trading with a very reasonable forward PE ratio of only 21.5 for a company that continues to expand their revenue in the high double digits every single year, and they have a market cap at $152 billion. And if you're unfamiliar with Adobe, this company owns the largest suite of digital design softwares in the world. They're the market leader in their respective industry, and they have products that are used from beginners all the way up to the most advanced editors on the planet. And this company generates revenue through a subscription model, meaning they charge a monthly or annual fee in order to use their suite of products, and they generate consistent and growing cash flow every single month from this type of business. And Wall Street has recently picked up on the stock, and they've actually raised their price targets going forward, and we saw a bunch of different firms raise price targets from $350, $360, all the way up to $400 plus per share. And if we take a look at a Morningstar report for the company, their estimated fair value per share for Adobe sits at $425. So with the current share price sitting right around $337, they're currently sitting at more than a 20% discount from the Morningstar estimated fair value. And if we take a look at Simply Wall Street, they also estimate, based on a discounted cash flow model, that the estimated fair value per share to be $401, meaning a 16% discount, or the company's over 15% undervalued at this current share price. And Adobe over the long term has posted some very strong and consistent results. And if we take a look at their 2022 performance, so this performance right now that I'm showing you is during the same period in time in which the share price has fallen by over 40%. Top line revenue growth of 15% annually to over $17.6 billion of total sales. They had GAAP earnings per share of $10 per share, and they had an operating margin at around 45%. So their business continued to expand at a rapid rate during fiscal year 2022, even though the share price has fallen by over 40%. So I think the share price has fallen way more than it needed to during this market pullback. And if we take a look, they're not growing based on one segment of their business. Multiple different segments are all growing in the high double digits, leading to the total top line revenue growth. So the company is expanding rapidly through many different segments, and it's not solely reliant on one single area in order to fund future growth. Their digital media division grew 16% year over year, their creative cloud was up 14%, and their document cloud was up 26% year over year as well. So all three areas of their digital media business posting very strong double-digit results. And this is why I consider Adobe one of the top growth companies in the market right now that's trading at an undervalued or fair price. It's because they generate a majority of their revenue through a subscription model. If you're a subscriber to the channel, you know I love subscription businesses because of how they operate and the consistent and growing cash flow they drive into their business. And if we take a look, over the past decade, this company continues to generate more and more subscription revenue. Their total revenue back in fiscal year 2012 was $4.4 billion, that is now growing to over $17.6 billion for the full fiscal 2022 year. And if we take a look, the dark blue section represents subscription revenue. So over 75% of their revenue comes in through a subscription model, whether it be an annual or monthly subscription, meaning they have consistent cash flow and very predictable cash flow flowing into their business. And this type of revenue is very sticky. Customers who once start using their products tend to not quit or tend to not unsubscribe over a longer period of time. And due to the digital nature of Adobe's business, they're able to operate with very high margins. And currently their operating margin comes in at 50%, meaning they're able to turn a ton of their top line revenue into bottom line profits. And if we take a look at their cash flow, which I believe to be the most important part of a business, we can see over the past decade continuous expansion in their cash flow from operations, now sitting at over $7.2 billion in 2021 fiscal year, And because of the nature of their business, they do not retire a ton of capital expenditures or physical assets in order to grow. So if we take a look at $7.2 billion of operating cash flows in fiscal year 2021, that turned into around $6.88 billion of total free cash flow during that same year. So this company turns all their operating cash flows into free cash flows, which is cash that can be used for future expansion, to reinvest back into the business, to buy back common stock, and allows the company to be able to return that capital to the investors like you and me. So overall, Adobe's financial statements look solid at this current point in time. And if we jump over to the balance sheet, it paints a very similar picture. Total cash at over $6 billion, receivables at over $2 billion, and their total current assets sit at $9 billion at this current point in time. If we take a look at their total liabilities for the next 12 months, or their total current liabilities, that looks high at around $8 billion. But if we take a look, a majority of that, $5.3 billion, is unearned revenue. And what this is all the subscribers that paid upfront for an annual membership, so they paid 12 months upfront, Adobe cannot recognize that revenue until they've actually performed the service. So as time goes on, this number will grow as more annual subscribers are added to the business, but this is not a debt. This is not $5.3 billion of cash they have to pay out to anyone. This number gets reduced as they provide their service obligations to the individuals who paid upfront for an annual subscription. So if you take away the $5.3 billion of unearned revenue, which I do not believe is a current liability because it's not a cash outflow for the business, they have around $3 billion of short-term debt with around $9 billion of total current assets. So a current ratio safely above 2, very close to 3 at this current point in time. And if we take a look at the long-term debt on the balance sheet, sitting at only $3.6 billion, so a very safe level, cash at around $6 billion right now, they can deal with all their total debt at a very reasonable rate, and I'm not too concerned with the balance sheet at this current level, and I do believe it to be very strong. And Adobe's been in the news recently because of a major acquisition. They decided and have agreed to a deal to buy Figma, a competitor in their market, for $20 billion. There is one major difference between Adobe and Figma, and that is that Figma's software was designed for collaborative efforts, meaning Figma was designed so different team members can all work on the same project at the same point in time. So you could have 5, 6 different people working in different offices all around the world, all editing on the same software at the same point in time. So it's more of a collaborative, team-based software. So Adobe agreed to a deal to purchase this company for $20 billion. So Figma was a private name, so we don't have any published financial statements yet, but in an article released by Adobe discussing this acquisition, they announced that Figma's total addressable market was $16.5 billion by 2025. They're expected to add $200 million in annual recurring revenue this year, surpassing total annual recurring revenue of $400 million by the end of 2022. They have gross margins of over 90%, which is incredibly high, positive operating cash flows, and their retention rate is at 150%, meaning their subscribers are renewing quarter after quarter. So they believe this will have synergistic benefits for Adobe. I think Adobe was also flexing their muscles here as the market leader worth $150 billion. I think they were just buying out a competitor to their business and bringing it under the Adobe umbrella. We don't know for sure if this deal will go through. I do believe it will. I don't think there's going to be any regulatory inflection into this deal because of the nature of their operations, but that is another thing to take into consideration if you're looking at Adobe stock right now. They have just agreed to a $20 billion buyout of Figma just in Q4 of 2022. So overall, Adobe is the first undervalued growth company we're taking a look at right now. The stock currently trades for $337, and like we saw, continuous double-digit revenue growth. Their subscription model revenue is very sticky. I personally really love that type of business model. They generate market-leading returns. The company continues to perform very well, and everything has been expanding cash flow, revenue, and profits during a year in which the share price has fallen by over 40%. And now we're going to continue on into the second high growth company we're taking a look at in your portfolio for 2023, and that is ticker AMD for Advanced Micro Devices. The company currently trades for $64 per share, and this is a leader in the semiconductor industry. On the 1-year chart, they have seen a major decline, now down over 55%, and I do believe this company is very oversold, and the market has overreacted to their current financial situation, and the stock's fallen way too hard, way too fast. And currently they're sitting with a very reasonable forward PE ratio of only 18.2 for a company that continues to grow top-line revenue by over 20% per quarter. And right now they have a market cap at $103 billion and are sitting very close to the 52-week low at this current share price. And if we jump over to a Morningstar report, the estimated fair value per share comes in at $109, meaning the company currently sitting at $64 per share represents an over 38% discount at this current share price from the estimated fair value. And if we take a look at Simply Wall Street, their estimated fair value per share based on a discounted cash flow analysis is at $105, meaning again around 39 to 40% undervalued at this current share price. So Morningstar and Simply Wall Street calculate the estimated fair value per share using different metrics, and both have determined the estimated fair value for AMD sits at above $100 per share, so a major discount at this current level. And one thing I like about this company is that they have a major different opportunity market compared to their competitors. A lot of the competitors in this industry sell one type of chip focused on one industry segment, but AMD operates and sells products for data centers, PCs, embedded in individual goods, and also the gaming industry, so that total addressable market is huge at $135 billion. And taking a look at their latest quarterly performance, even though the share price continues to fall, their last quarter was very good. The earnings declined because of a recent acquisition, but the top line revenue continued to expand and grew 29% overall for the entire business, from $4.3 billion back in 2021 to over $5.6 billion of quarterly revenue in Q3 of 2022. So for a company that's seen a slight pullback in earnings due to increased costs based on a recent acquisition that's actually have synergetic benefits for the company long term, I think the market's overreacting to the short-term decline in EPS, but overall the top line is still expanding at a rapid rate. And if we jump over to their income statement, they've been growing top-line revenue at an incredible rate over the past few years. $5.2 billion of sales back in 2017, up to 6.4, 6.7, and then from 2019 onwards, we've seen some major expansion. $6.7 billion of total top-line revenue, up to then $9.7 billion, then it pretty much doubled to $16.4 billion, and now we've seen a major growth rate to $22.8 billion of total sales in the trailing 12 months. So this company's total sales and expansion has been astronomical and exponential over the past 5 years. And if we take a look, their expectations for Q4 are 14% annual growth. They expect to have a 51% gross margin, which is very high in this industry, and going forward for the full fiscal year of 2022. So in the year that we've seen the share price drop 55% overall from 12 months ago, they're projecting total sales growth of 43%. So for a company to grow top-line revenue to over $23.5 billion, expanded by 43% over the prior year, and still have their share price fall by over 55% in that same period, I believe the market is overreacting. And if we take a look at their balance sheet as at the end of the latest quarter, this company is in an incredible financial position, and this is why I included them similar to Adobe in this video. I like focusing on growth companies who have very strong financials. There's a ton of companies out there. There's thousands who have terrible balance sheets but are still growing revenue at a fast rate, but the companies aren't going to go anywhere because they can't fund their growth because of the weakness in their balance sheet. But AMD is the complete opposite. If we take a look at the end of the latest quarter, they had cash and cash equivalents of around $5.6 billion, receivables of over $4.3 billion, and inventory of over $3.3 billion as well. So, but when we take a look at the favorite metric I like to see is the total debt on the balance sheet. Their total debt for the entire company sits at $2.5 billion. Their cash on hand sits at $5.6 billion. And their net debt, so their total cash left over if they were to pay off all the debt for the entire company, short-term and long, is a $2.4 billion surplus. Meaning the company right now has a surplus of cash of $2.4 billion. And one thing I like even more is that they generate a ton of positive free cash flow. Taking a look at their historical free cash flow, of course, as the company was younger, they were growing, they were not free cash flow positive, but for the past 4 or 5 years, they've generated growing positive free cash flow. And in the trailing 12 months, they've generated over $3.4 billion of cash for the balance sheet, which is why they're in such a strong financial position, and they're not relying on external debt in order to grow the business. And if we take a look at an analyst report for AMD, the average of 38 individual analysts that all work for different companies has an average price target of $91 per share, representing more than 34% upside from the current level. And if we take a look at 43 recommendations, there's 13 strong buys, 19 buys, and 11 holds, and no one is selling out of this company at this current point in time. So overall, we can see Wall Street's perspective on AMD is very positive, recommending it as a buy or a strong buy, and the company is forecasted to grow at a decent rate going forward. So AMD was the second stock in this video, and now we're going to conclude by saying Adobe, AMD, Two companies that have seen a major pullback in share price throughout 2022, down 40 and 55% respectively. These companies have positive cash flow from operations, positive free cash flow, they're growing top line revenue, their balance sheets are strong, and overall the financial statements are looking very good for two businesses that are now trading at an undervalued level according to multiple different reports. So overall, AMD and Adobe, two companies we're taking a look at for your portfolio to start out 2023. So thank you for watching all the way to the end. Please hit that like button and subscribe, and I will see you in the next video.